Good morning, everybody, and welcome back to Beat the Bell, presented by Kane Cap. Hope you guys are all having an awesome week thus far. The turbulence in the markets continues. Yesterday, we saw a pretty decent sell-off. When are bulls going to get the chance to step in? When are they going to turn things around? We are getting a little bit of a push higher in the S&P futures to start the day, likely trapping some shorts from overnight, but we've been seeing a lot of these relief pops, and none of them have had any sense of sustainability. So it is something to continue to monitor. Money Mander, good morning.
Good morning. Happy hump day, and nail on the head there. Been getting a lot of relief rallies overnight, but volatility is definitely back, and we're seeing them all get sold at the open. So we'll see what we get today.
All right, Diamond Trades.
Morning. Happy Wednesday. Let's get after it. Got a lot to cover today.
And Stock Snipa.
Good morning. Let's get to it.
All right. Fed forecast and economic calendar.
Yes. Let's start with the economic calendar for today and the rest of the week. We've got S&P Global Composite and Services PMI that's not true, not at 8:30. That's at 9:45. That's on me. And then the ISM Services PMI is actually at 10 o'clock. This was a break of an economic calendar by me. My apologies, guys. But yeah, ISM Services PMI will be out at 10. That's going to be the high impact news for the day. Factory orders also out at 10. And then we've got Fed speakers 10, 10:30, 11:25. So just littered throughout the day and really littered throughout the week here. As far as Fed speakers go, we have a ton of them this week. And we also had Powell on Monday. So it seems like a nonstop parade of Fed speakers this week, and that'll likely be the case going forward throughout until their meeting in November. And then obviously NFP on Friday is going to be the biggest high impact news driver of the week. Let's go ahead and talk about this week's trading. So as Alejandro alluded to, the market's weakness has continued this week with the NASDAQ falling just under 2% yesterday, the S&P dropping 1.4%, and the Dow losing 1.3%. The Dow has now completely erased all year-to-date gains, bringing it to minus 0.4% on the year since the start of 2023. So all of the Dow's gains have been erased. As you can see, the S&P 500 is still sitting up just slightly at 10%, and the NASDAQ is holding on to a 25% year-to-date gain. The 10-year closed trading on Tuesday at 4.8%, the highest close since August of 2007. The dollar index inched higher by almost 0.5%, closing the session at year-to-date highs. We talked about how those two showing strength is going to provide headwinds for stocks. Indices and yields are not the only thing on the move. However, in the past week, we've had expectations that the Fed is likely to raise rates at their next meeting. We've had those expectations increase almost double here in the past week, up to 30% this week from 16%. So previously, still the favorite. The market is pricing in basically that the Fed is not going to hike rates at their next meeting in November. Their next meeting is in about 28 days. Previously the market was pricing in about a 15% chance, and previously, meaning like last week, the market was pricing in about a 15% chance that we were going to see a 25 basis point increase. And that probability has nearly doubled up to 30% this week, likely due to some of the economic readings that we've gotten. Particularly, we got a hotter than anticipated JOLTS report, which showed 9.61 new job openings, higher than the anticipated 8.7 and up from the 8.9 last month. So showing that the real economy and the labor market remain resilient in the face of challenging financial conditions. That obviously is going to that increases the probability here as the real economy and the labor market show strength. That increases the probability that the Fed is going to want to hike rates one more time, just to sort of get that under control and make sure that that's not going to cause a resurgence in inflation. And then the last thing I wanted to talk about here is yields. So this historic rally in yields has some, particularly Mander, who literally texted me this exact question yesterday, begging the question, is the top close for yields? And is it prudent to capitalize on what BlackRock calls a generational opportunity in the bond market? Investors don't seem to be fully sold here, with $78 billion worth of outflows from U.S.-based taxable bond funds over the 12 months through August of 2023. While that is lower than the $300 billion that has been pulled from equities over that same period, it's not exactly what you would expect to see at a long-term bottom for bond prices. So investors in both the bond and equity markets seem concerned about exactly where the Fed is going to pin rates, where that final hike is going to be, and before really rushing into to capitalize on, again, what BlackRock calls a generational opportunity in the bond market. Mander, what do you think?
Yeah, I think there's two scenarios here that we were kind of talking about yesterday. Either the Fed actually sends rates to or holds rates where they're saying to in the recent projections after raising them in June and then again in September, or we were kind of talking about the scenario where maybe it was just Fed talk to tighten markets without actually having to hold them there, which one of two options, they both could pan out. But regardless, it is doing exactly that and tightening markets significantly, especially the bond market. And so if we take a look here, especially globally, you mentioned the word historic. This actually has been a historic run in the 10-year globally. It's been the highest one-year move in the 10-year cumulatively across the entire central banks of the world that we've ever seen in a one-year period. And so obviously the Fed and us here in the U.S., the Fed still remains one of the most hawkish central banks, and that's what's leading to the dollar running in comparison to the yen and to the ECB and the euro. So going back over the past month here, what we have here, you compare the dollar, the 10-year, and the S&P 500. Seasonality had kind of already began to take shape, and bond markets were already beginning to price in that continual beat in economic data. But look right after this vertical line here, which was that FOMC meeting on September 20th, where they increased those projections yet again for 24-25. The move is parabolic. The 10 years now up 50 basis points or half a percentage point in just 2 weeks following that meeting. So to me, and what we were talking about, it's really starting to beg this question to where could the top be in yields, and especially the 10-year, which has been on the biggest move. And then whether markets continue to price higher for longer here, or data just begins to worsen as they begin to price in recession. And so that's really the two things we get to think about here. The 210 inversion is now sitting at just 36 basis points, which is down from that full percentage point at the peak. But there's two ways this could uninvert. Either we have to see the 10-year then cross the 2-year and pin above a 5 handle. Right now, I think the 2-year is trading at 5.1. And so you would have to see for this to then uninvert for a longer duration, which always happens after a hiking cycle. You would then have to see a continual hold of the 10-year above a 5.1 percentage point. Or we start to see that, historically we never get the soft landing that's being priced in. And then the shorter duration of the yield curve takes that massive tank as we get the massive rate cuts coming from the Fed. And then you would see the 2-year just drop more aggressively than the 10-year and fall below that way. Right now, I think markets are really pricing in soft landing and higher for longer as data continually seems to beat to the upside. But then that leads to a 10-year that we see for a longer duration pinning above a 5.1% return and a yield. And so then the question then at that rate gets to how long can that sustain in the whole system here? As it goes just back to March, that was 70 basis points ago in the 10-year where you had all of those issues stemming from bank deposits and the bank runs. Now, if we trade over a 5% for a longer duration, as you have this BTFD bailout program, then the payments are coming due in March, do we then get into a scenario where banks begin to get underwater again with the hold to maturity portfolios having more unrealized losses now than they even did back in March?
I lost you on like the last little bit of that. But what I did want to touch on that completely, my alarm went off. It's my fault. But what I did want to touch on is like you said, the uninversion of the yield curve. I think realistically, once that's really going to rely on economic data, right? Because I think that as you start to see economic data deteriorate, as you start to see maybe the labor market cool off a little bit, we've seen the labor market be extremely high. I referenced the JOLTS number that we got yesterday. If you start to see the economy cool off a little bit, I think that's going to give you that pullback in the shorter term yields that you're looking for, right? And that will be where the yield curve sort of inverts, and we won't have those short duration yields being higher than the 10-year. And I think that that's probably what the market is waiting on in terms of the yield curve anyways, to see that 210 uninversion. I think that once you start to see the economy sort of cool off, which we really have not seen sustained evidence of at all this year, if you start to see that, I think that then you can expect to see a bit of an uninversion in the yield curve. And I think that at that point, that's probably when you'll start to hear people talking about, okay, maybe this is not, the fairy tale soft landing that we all thought it was going to be. And I think that that's really where the rubber will meet the road. And I think that that's where things will start to get interesting. That'll wrap it up for us here at Fed Forecast. We can pass it back to Alejandro.
All right. Let's take a look at the system before we go over to Snipes for Bet the Bell. So the same story that we talked about on Monday, right, guys? So the relief pops, as I mentioned earlier, have been seeing very little sustainability. It's been relief pops into the 50 SMA on the 1 hour chart. As we can see here, we're still in a strong downtrend. Now, today we are up, a decent bit, 42.35. About 45 points off of the lows. Okay. Overnight in the S&P futures. So it'll be interesting to watch if we can get some sort of continuation. But what bulls are really going to want to see is a reclaim of the 50 SMA on the 1 hour chart and, of course, on the 30-minute chart. And once those moving averages start to tilt higher, that is going to be our visual representation that momentum is shifting in the market. Also, this week, the first week and second weeks of October, if seasonality continues to track, which it has perfectly so far with the late sell-off into September, and then generally we see more weakness to start October before an October low and bottom gets put in before we rally into the end of the year. That would be happening this week or next week. And so that's something that's very important to be keeping an eye out for. Understanding that although we have gotten this pretty severe sell-off that has looked pretty nasty, we could be taking a turn for the better here soon based on seasonality. So that's definitely something that I'm going to be keeping an eye out for. Let me go over to Snipes now for Bet the Bell.
Time for the best part. So we're going to typically start off how we always do. We're going to look at the standings. We're going to see right now Diamond Trades and Alejandro have been going at it at the top, and we could see Mander slowly tailing behind, and I'm actually in the bottom. Whatever, that's relevant. Going on towards our first question, as always, green or red today? I'm going to have to start this one off with Mander.
I am going to take green today, which has been the fade, the overnight move has been the trend. But seeing that close in the VIX under 20 yesterday, I think the Bulls try and hold that for a little longer. I'm going to take green.
I like it. Alejandro, what you got?
I'm going to take green as well.
Ooh, Diamond's thinking there for a second.
Yeah, I think just for the sake of the markets, I'm going to go red. I know if I go green, Snipes goes green. It's a wrap for us. So I'll take one for the team, and I'll go red here.
That's appreciated.
Okay. I'm gonna have to take green. I was gonna be that guy though. I was gonna be that guy if you took green. My next question for you. I'm not sure if you guys have seen it or not, but there's videos of Chipotle now having robots completely make the bowl. The one thing that I find that's pretty interesting about this is that there's no human work there whatsoever. And my question for you guys is this realistically accomplishable by 2030? Now, the thing for those of you who may not be familiar with Chipotle, if anybody is not, it is a fast, smart restaurant. I'm not sure the name.
The Mexican fast food chain. What do you mean?
No, but I got you. But there's I think it's called like Smart Casual or Fast Smart or something for
Fast casual.
Fast Casual, I believe that's what it is, for where you go walk across and you like customize a bowl or a sandwich or whatever the hell you want. My thing is at Chipotle, if you wanted more rice, you ask the person for a little bit more rice. If you wanted more beans, you ask the person, let me get a little bit more beans. You want something else, whatever, you ask it. Now, realistically, how accomplishable is this by robots? If they're going to have set portion sizes, it would probably be more consistent. However, what if people want specifics when it comes towards making Chipotle? Does that make this something that's realistically attainable by 2030? I'm going to go ahead and start this one off with Diamond Trades.
I'm a little bit biased because Chipotle is probably like my favorite restaurant, like in terms of like, I guess, fast food, if you want to call it that. It's weird. So the company that they essentially are partnering with to do this automation is called Hyphen. And when you look at the space, like the automation space in terms of fast food. Like Chipotle to me just is one of the most difficult things to automate. Like it's not like a Burger King where it's like, you know, you have your menu and you sort of like if somebody gets a burger, like, you know, it's kind of relatively simple. I think that, like you said, if you want like a little bit more of something, a little bit less of something, it makes it a little bit more difficult to have that customization. So for me, I don't love it. I hope that they don't have this fully automated by 2030. I don't even really think it's going to be possible. And then the burritos, right? Like sometimes my burritos are absolute like missiles, like they're bricks. Like I just don't understand how, you know, a robot is going to be able to come in and be able to wrap that thing up in an appropriate way. I think that you need somebody who's specially trained in dealing with that type of size and girth. Like that's what I think that you need. And so, I mean, just personally, I hope that this is not something that comes to fruition. So I'm going to go with no.
Devin wants someone that is specially trained to deal with the size and the girth.
Right.
Another little thing I got, you know, a comparison towards a restaurant that is actually fully automated, and I know Mander is somehow not sponsored by them, but if you go to Wawa, you will soon meet yourself with a screen, and there you will completely order via robots, which is many places I see that you completely order by them.
Different.
However, the production of the actual food is made by humans.
I was about to say, it's not even remotely the same. It's
well.
Different, but good segue. Let me get into this because that's what I was going to say. And I know you've mobile ordered from Chipotle before, Noah, and so that's what I was going to say. With customization, if you've ever mobile ordered off Chipotle, you can do half portions, you can do double portions off of the mobile order. That's where I see Chipotle going with this, is a Wawa type interface where you go up to a screen, you build whatever you want, and then the robot just dishes you out. You get down the line, you pay, you're out of there. And so I think the only thing that could not be automated is the actual cooking of the food. But I could definitely see Chipotle going a route where you walk into the screen, you type in what you want, you edit all your portions, the customization you guys are talking about, and then that new robot just spins it all out for you. You walk down the line and grab it. I could see that absolutely happening by 2030.
All I know is that if I go to a Chipotle and this automated robot is like skimping me on my rice,
or you give the guy a little wink, like, yo,
I'm gonna get aggravated.
Extra steak, you give him a wink and get a free double portion, like no more of that. But
like then we're gonna have problems if things like that start to occur. To be honest.
But then think what that does to Chipotle's top line.
Interesting, right there. Alejandro, what you got for me?
Yeah, this would be pretty cool. I don't really see it happening because of I'm just envisioning a lot of problems presenting themselves, like people, especially when they're paying for food. I mean, you know, people will go to like high quality, 5-star Michelin rated restaurants, still be a massive pain in the ass. Like imagine they walk into Chipotle and a robot isn't making their food exactly how they want it. They're not going to have anybody to complain to. They're going to go to Yelp or whatever, and just I really don't see it working out as far as like actually pleasing customers.
So there's one variable that nobody has brought up that I was waiting to see, but in my opinion, again, if anybody works at Chipotle, please don't take this the wrong way. But they pay those guys too damn much money. Too much, man. And I can't tell you how many times they have very simple tasks and they fail to execute it right in front of me, and I see it live. We've all been disappointed by Chipotle before, at least once. It's definitely happened. And those guys are making 20 plus an hour. I think that those guys are paid too much, but that's just my opinion on this. I also think that that's a huge factor for why they want to automate the process because of high labor costs right there. But yeah, overall, I think that it is realistically possible to attain by 2030. But as far as the feasibility, I would say we have a low chance by 2030, but I could definitely see this coming one day in the future. I'm going to go ahead and jump over towards my next question. And my next question is pretty interesting. But if you were gifted $100,000 and you have 1 year to double it, how are you going to do it? I'm going to go ahead and start this one off with Alejandro.
I would go with Tesla. That's what 5% a year over the next, or is it 10 years? 10% a year over the next 5 years. Oof. Oh wait, is my math not 10% a year? Excuse me.
A little bit less, but continue.
Okay.
More or less.
Whatever. Now I'm just hurting my brain and not answering the question. Yeah, Tesla. Look, this entire year we've been talking about how these auto companies are likely going to struggle because of rates. And we've seen that, it's honestly been a pretty good year for Tesla. And I think that they are continuing to put people in Teslas. They're continuing to grow in market share. There's a lot of noise surrounding the stock in general, and that's kind of just the nature of holding Tesla stock is, be prepared for the stock to sell off 4% on missed delivery numbers. Be prepared for the stock to sell off after a bad earnings, but somehow, some way, Elon continues to say the magic words that are necessary and the stock continues to climb. While I do believe that they are still positioning themselves extremely well for the future, especially over the next 5 years. Definitely one of my favorites to own, and I can see it doubling my money.
I like it. Diamond, what you got?
I'm gonna go with Rivian. Take a page out of Alejandro's book. I think that if the whole electric car segment sort of like grows moving forward, the market grows, which obviously it's projected to, and Rivian can gain market share. I think that they'll be able to have a nice return. Obviously, a little bit more higher risk than Tesla, because I know that Tesla's involved in like several other things, and it seems like the share price of Tesla is more correlated to how much belief investors have in Elon as opposed to like, necessarily how great of a car maker they are. So I do think it's like probably a higher risk, but I also think that like depending like in a market environment where let's just say that we have choppy trading conditions for the next year or so, and then we resume some sort of reasonably steady uptrend. I think that in an environment like that, you could see a company like Rivian sort of exceeding, particularly if they can gain market share in the space. So I'll go with Rivian.
I like it. Money Mander.
This is funny. We all had the exact same thought. I'm going to take Lucid. And I think to have the potential to double an investment over 5 years, you're going to need to chase some of that volatility, which obviously all of us are thinking the same thing here. I'm just going to go with Lucid trading pretty much right at year-to-date lows, right around $5. So basically, can this thing actually get profitable and start spitting out some cars? It's the production issues is the problem. But I think they're great vehicles. And so can this get to $10? I like that bet over 5 years.
I don't know. Positive real yields in a situation where Lucid is just like bleeding money. I just don't know about it. That's just, I don't know.
I think they got the funding to hold out the waters. I'm starting to see them on the road around me.
So am I. I have, to be fair, I have started to see quite a bit of them. So I'll give you that.
We shall see.
I'm gonna have to go with to be honest, if I did have to double it, I'm gonna drive over to a horse racing track, and from there I'm gonna bet on the largest horse and then just hope. No, I'm joking. If I had to double my investment within 5 years, I'm probably going to strategically spread it out, but a lot of it being in that EV space, I'm going to have some Tesla. I think I probably will go with some Rivian. Just like you were saying, I've seen a lot of the Rivian trucks lately. I think that I probably will stay away from some of the smaller EV names, but I'm also going to probably want to throw about a quarter of that in AI. I'm going to say 50% of it in EVs, a quarter of that inside of AI, and a quarter of it inside of energy. And I would have ExxonMobil specifically. And just for that per chance that we do see another gas spike, which is very likely based off of how the economy cycles. That's how I would strategically place that out if I were to double it within 5 years. But that'll wrap it up for Bet the Bell today. I'm going to pass it back to Hondo here.
All right, guys. Appreciate everybody who tuned in. We'll see you back here on Friday morning. We'll be live trading all day in the King Capital Discord. You guys can go to kingcapital.com, sign up, or scan the QR code on the screen. Have a great rest of your days, everybody. Take care.